Hey, it's Michael Saul, but everybody calls me Tiny, and this video is why the inverted yield curve brings opportunity. This is stock market analysis for the week of March 25th, 2019. If you would like to receive intra-week updates, go to www.attackthemarkets.com, put in your first name, your best email address, follow directions, and you will be on the distribution list. Facebook group is at facebook.com/groups/attackthemarkets. If you like what you're hearing on this video, and come on, you know you do, give me a thumbs up and leave a comment so I can move up the ranks in YouTube and others can enjoy watching this video as well. And if you never want to miss a video when I upload one to the channel, click subscribe and smash the bell and you'll be notified when I upload a new video. Okay, great. Let's take a look at the market. First, let's address that 800-pound gorilla in the room. And no, it's not me. I am not that big, although I have gained some weight back since pausing my keto. Okay, the inverted yield curve. If you watched any of the financial news networks or you read anything online, probably the regular news networks too, which I try to avoid, everybody was talking about the inverted yield curve. So here's what happened. The yield on the 3-month, Treasury bills is now greater than the yield on the 10-year Treasury notes, right? So 3-month bills, the yield is greater than the 10-year notes. And what happens with bonds is it's an inverse correlation. When there is a demand for bonds and people are rushing in to buy them, whatever the maturity is, the yield will fall. So what this means is there is a greater demand now, big demand for the 10-year notes. And so much of a demand that it is dropping yields, and it dropped yields below the short-term 3-month bills. Usually how it works in a strong and a growth-centered economy, everybody is confident, usually the lower maturity dates will yield better than will yield less, there we go, less than the longer out maturity dates, okay? So what this means is confidence in the economy staying robust is now waning. And people are putting money into longer-term Treasury instruments because they feel that something is going to hit the fan, and that something is a recession, right? Usually this is a recession indicator. Usually when the inverted yield curve occurs, within 12 to 18 months, a recession hits, okay? Now, that's the bad news as far as the recession is concerned. But let's talk a little bit more about why there is concern here across the world, right? Because it's not just Americans that are buying the 10-year notes. It's all from all over the world. So, first of all, the trade wars going on. Now, yeah, it's kind of calmed down, and things are looking to be worked out, and every week there seems to be some progress, and then maybe a few steps back, and then progress again, but it's far from complete. Okay, there is still that the trade war looming between the U.S. and China. Now, Europe may already be in a recession, and if you haven't read everything on Brexit and the problems with that, if that's messy, that's more than likely going to put a damper on growth prospects for Europe. And usually how it works is as Europe goes, the rest of the world goes. Like despite the U.S. being the dominant economy, everything, but Europe is a very big influence on the world. Okay. Also, there was the Duke CFO survey, and 82% of chief financial officers believe that by the end of 2020, a recession will have begun. Now, again, that's just a poll, right? But it's, these are all things that are adding up, and there's definitely some nervousness going out and seeing if the economy in the U.S. is going to continue to grow. So they go to a safe haven, which, the 10-year note's one of the safest havens in the world, and they're putting money there. So why is that opportunity for stock traders? Is it going to be an opportunity for us to short or to go long? Well, the deal is, like I said a couple minutes ago, usually the recession doesn't kick in for 12 to 18 months, And before that happens, the stock market usually rises. So I am still in my belief that we will hit all-time highs here, at least in the S&P 500. I think that when we do hit those highs, and I don't think it's going to be next week or anything like that, but I do think that when we do hit those highs, we really have to get our Dow theory hats on. Okay, maybe not traditional Dow theory, but the modified Dow theory, where we're looking at what is the S&P or what is the broad market doing with the NASDAQ, and doing with small caps and the mid caps, etc. Right? That's what I want to look at. I want to see if there's any divergences up there, because if we do get to new highs, depending on how long it takes, it could lead to a sell signal. But we're not there yet, right? One step at a time. All right? I believe that Friday's move was the typical overreaction. And the market, I mean, look, the S&P rather was down nearly 2%. The other indexes were down worse, and as we'll go through them. I think it's an overreaction. I think we could get some residual weakness, but I don't think we're going to pull back very far, and I believe that's going to be a buying opportunity. Okay, we are back down below the resistance that we broke about, a week and a half ago, whatever it was. And Thursday was such a nice day, too. Everybody was all excited. Look at the day. Oh, look at Thursday. We're definitely going back to new highs, only a couple percentage points away. And then Friday came in, and we're back down below the resistance. Okay? So I want to watch the 200-day moving average. If we continue to fall, we may not. We may just turn and burn, but I think that's just really a guess at this point to think, oh, Friday was no big deal. We're just going to go higher from here. Yeah, not quite. And I want to see what sets up here over the next few sessions before I can make that determination. Now, the Dow had a lower high in place, also has the 50 and the 200-day moving average. The NASDAQ was acting the best. NASDAQ was really just one more good day away from getting up, or maybe a good day and a half of getting up to its highs. Friday gave it back 2.2%. Watch the 20 EMA. But the Russell got smacked the worst. And the Russell is now down below the 50-day moving average again. I crossed it in January, but now it's back down below it. And you can see here down 3.64%, the IWM. Not nice. This is another sign that, the global economy, right, because small caps tend to perform well where there is confidence in both the U.S. and the global economy, and they tend to get hit the hardest when confidence decides to leave or start to wane, right? So we have to watch this right here, and we have to see where this is going to continue. The banks also get hit when the yield curve inverts. So let's look at some of the sectors. Semiconductors were acting really, really nice, just shy here. All right, if we go to the weekly chart, we'll pull up the weekly chart here. All-time highs here on the semiconductors, just shy of those. And instead, Friday basically gave back the gains from Thursday. Let's look at some of the glamour stocks. You got KLA Tanker pulling back now. Watch the 20 EMA, see if it holds. How about NVIDIA? So we watched NVIDIA. We watched this range form. It busted out. Had a nice day on Thursday, but Friday gave a good portion of that back. Banks, they got hit right into the 200-day moving average on Tuesday, reversed there, and then just Wednesday ugly, Thursday semi-ugly, and then Friday really ugly. I'm avoiding the banks for now. If anything, I'll be looking for short setups if they occur. If we get a good coil, flag, or pennant, right? You can look at Bank of America, Citigroup, J.P. Morgan, just avoiding these. Goldman actually held up better than the XBD overall, the broker-dealer. But again, I'm not looking to be running into buying any of these just yet. I really need to see what shakes out over the next few sessions at a minimum, because the 200-day holding, and yeah, we did get above it, but we didn't go anywhere after we got above it these two times on the XBD. And if you look at the banks, I mean, we basically smashed right into it. Yeah, that's not a good sign. All right, there was sellers waiting up here, and then boom. All right. Now, granted, you can, of course, tie it to the bonds and how coincidental it is that bonds decided to rise and the yield curve inverted here. But, yeah, it's also kind of coincidental, right, that it ran right into that 200-day moving average. Like, look, if you don't use charts, you're doing so at your own peril. right? Charts are a very important tool in the toolbox with making decisions, but enough of that. I'm not going to get on my soapbox here. How about biotechs? So I haven't looked at biotechs in a couple of weeks. They really haven't been doing anything. They had a nasty day on Friday, down 3.5%, and you can see Biogen had a nasty couple of days, late stage Alzheimer drug or late stage trials for an Alzheimer drug, whatever. And, what I wanted to point out here is a lot of people look at biotechs as risky stocks. And some of the smaller ones especially, they point to that just don't do anything, and then they have the trial results coming out and everything, and they can move. But, bad things can happen to the big stocks too. I mean, Biogen's a pretty big stock in the biotechnology sector. And look, if you sold calls while you were in this range, hey, great, you did great. If you did a spread, you may have got hurt a little bit, but your losses were contained, right? But if you sold naked puts, yep, I mean, you're definitely hurting here, right? And if if you own the stock and sold calls against it, yeah, maybe the calls gave you a little shelter, but not the kind of move like this. I mean, this is just a nasty, nasty move. So you always have to remember your risk parameters. I'm not telling you never trade biotech stocks or anything like that. Just always remember, just because they're big stocks doesn't mean they can't get moves like this. Right? It can happen, and it's not just in biotechnology, right? Of course, other sectors don't have, phase 3 trials and results, pending results and all that stuff. Great, but I mean, yeah, big moves can happen. Okay, so people just think, nah, it's not going to happen. Look at the range we've been in. We're not going anywhere. Look at this range over the last few months, and then all of a sudden, they get cracked open. It's not just the small stocks. Okay. Anyway, let's keep going. Let's look at some of the glamour stocks. Amazon popped up through the 200-day moving average Friday, down 3%. Watch the 200-day if it continues to fall. Apple, we watched this one a couple of weeks ago, popped up over the 200-day moving average, now came back to test it. Facebook not doing much, so I'll leave this alone for the time being. Alphabet, nice stair-stepping move. Had the down day on Friday, though, down 2.3%. Let's see where this goes, if it puts in a higher low or if it continues down to the 20-day moving average. Caterpillar maybe moving away from its bunch, right? It's bunched up here. See where it's going to go. You have support down here at 123.10. And John Deere, more sloppy than anything. But if it does take out the lows in February, watch for the 200-day moving average to be tested. We didn't look at Tesla. That's what we didn't look. We didn't look at Tesla. Tesla looks like it's headed back to the October 2018 lows, if not the 2018 yearly lows back in April. Yeah, I don't see a buying opportunity there. Here's Netflix as well, just more sideways action than anything. I mean, down 4.5% on Friday, but really just still in this range. Gold. So gold has a double inside candles here, so I'm looking for range expansion here. No real move to gold there, no real flight to safety in gold with the market getting hit Friday, something to pay attention to. Here's oil continuing to grind its way up. It had a down session on Friday, but not much. It's still trying to grind its way. Watch the 200-day moving average. This is the USO. I use the ETFs or the spiders or whatever it is. I like to use these to look at the bonds, gold, and oil. And here is the TLT, the aforementioned bonds, which has been on a nice rip here. Now, of course, it's overextended, so I would not be surprised to see if it gets a pause here. All right. So, again, let's recap. The yield curve has inverted. The yield on 3-month bills is now higher than 10-year notes. Now, it's only been for a day or so, and the person that did a lot of work into, a lot of research into the yield curve, okay, and he's considered the expert. His name is Campbell R. Harvey. I'll link in the description here on YouTube. I'll link to his article. It's a great article, and you'll hear a lot of the stuff that I reiterated, because I read a ton of articles, but this guy, in my opinion, he had the best stuff to say. He said that it's not just a few days of the inverted yield curve that really lead to the recession signal. It has to be a quarter, but he thinks it's headed that way. So anyway, I'll link you to that. But in the meantime, there is short-term opportunity here on the upside. Even if a recession is coming within 12 to 18 months, and the stock market rising usually precedes that. Again, I don't know if it's a buy signal right on Monday, but I am going to be watching for a buy signal here sooner rather than later. Okay? Questions, tiny@attackthemarkets.com. I will talk to you in the intra-week updates if you sign up for the list at attackthemarkets.com. Otherwise, I will talk to you again in next week's video. Have a great trading week.